guys, Brian Davis here from Spark Rental. So let me know where you're tuning in from as you join us. I always love to hear that stuff. Makes it feel like it's more of a dialogue here and not just a monologue. So last week about creative and safe house hacking tactics during COVID-19, during the pandemic, because let's be honest, not all house hacking tactics have been as tempting during the pandemic as they normally are. This week, we're talking all about how a Biden presidency tax changes would affect you as a real estate investor. And yes, there's some inherent politics here, but we're going to keep it very neutral and politics-free. This is not a political platform, of course. This is a place to talk about real estate. So Biden is leading in most national polls. So it looks ever more likely, as we're just a couple weeks away from the election, that we will have a new president come January. And he has proposed some pretty significant tax changes, many of which would affect real estate investors. So we're just going to go through a quick summary of the specific tax policy changes that he's proposed that would impact real estate investors. We're not going to go through all of his tax changes or proposed tax changes. That would take way too long. But we're going to go through the highlights of the ones that will or would affect real estate investors if they come to pass. So we're going to dive right in here and jump in with a higher maximum income tax rate. So the highest income tax rate currently, again, this is all the federal level. Every state has their own income tax rates. But right now, the highest income tax rate is 37%. And Biden would like to re-raise that back up to 39.6%, which is what it was previously under the Obama administration. It was dropped from 39.6% to 37% in the Tax Cuts and Jobs Act of 2017. So again, this is the top income tax bracket, and this would only affect taxpayers earning more than $400,000 a year. The sister change to this proposed tax rule is that in addition to the higher federal income tax rate, these higher earners would also be subject to paying Social Security taxes on their income over $400,000. Right now, people only pay Social Security taxes on their first $137,700 of income, and then it disappears. This would reinstate the Social Security tax on income above $400,000 for higher earners. So double whammy there for higher earners. Again, this is for people earning more than $400,000. So it does not affect most Americans, but it does affect some. So worth mentioning there. So Michelle says that she's having trouble hearing me. Let me know if anyone else is having trouble hearing me as well. And we'll look into the microphone situation here. It looks like everything is working normally from my end, but you never know. I'm not on the receiving end. So, all right, second change that is proposed under the Biden campaign is a change in how long-term capital gains are taxed for higher earners. Now, again, this change would only take place for people earning a significant amount of money, more than the average American. This change would be for people earning more than $1 million a year. So for those people earning over $1 million a year, capital gains would be taxed at their regular income tax rate. And for those earners, that's 39.6% under the previous change that we just talked about. So long-term capital gains would go from 20%, where it is currently at the highest level, to 39.6% for high earners. And it looks like Trent Thompson says that he's hearing okay. Tara says that she's hearing okay. So Michelle, I don't know what to tell you there. I'm sorry that you're having trouble with the audio, but it does look like it's transmitting. So, and hopefully Deni joins me here too momentarily. All right, so third proposed change for taxes that would impact real estate investors is Biden has proposed eliminating the step-up basis for inherited properties. Now, if that sounds like Greek to you, we're going to convert that to plain English. So the step-up basis for inherited properties is when you currently inherit a property when someone dies, the cost basis for accounting purposes, the cost basis changes from whatever the original owner paid for that property to whatever its value is at the time of their death. So let's say that your parents bought a house for $50,000 30 years ago, and today it's worth $1 million. If they were to die and pass that property on to you, the cost basis would step up to $1 million, to its current value. So you would not have to pay capital gains taxes on the appreciation on that property. Now, so that's what's called the step-up basis in accounting for properties that are inherited. So the Biden campaign has proposed eliminating that step-up basis. So you inherit that property that your parents bought for $50,000 30 years ago. It's now worth $1 million. So you would actually pay capital gains taxes on that $950,000 of appreciation that's taken place over the last 30 years. So, a little bit getting into accounting speak here, but hopefully that is clarified to plain English for all of you who don't speak accounting. And it looks like Deni has joined us here. We're going to add her in. And Edwin says that I'm clear on the mic for him as well. All right, so that's the first 3 proposed Biden changes that would impact real estate investors and homeowners or people who inherit properties. 4th proposed tax change that would affect real estate investors is Biden has proposed limiting itemized deductions for those earning over $400,000 a year. So what he's proposed is that itemized deductions will be capped at 28% of their value, even though people earning over $400,000 a year would be paying taxes at the 39.6% income tax rate. So there would be a gap there between the maximum allowed deduction benefit of 28% versus the income tax rate that higher earners would be paying, which is 39.6%. So it limits the value of itemized deductions, again, only for higher earners, but for those earners, it is a very real change. Now, that particularly impacts higher income homeowners who are taking advantage of the mortgage interest deduction, which is a big deduction for a lot of higher earners, with more expensive properties, higher loans, higher interest. So that would have a bigger impact on higher income homeowners who are currently taking advantage of that mortgage interest deduction. It's worth mentioning that this only applies to personal itemized deductions. This does not apply to business deductions or real estate expenses for real estate investors. So this is for your personal itemized deductions. This does not impact your rental properties or your expenses as a real estate investor. Those are business expenses. Those are always deductible from your gross revenue as a business. So just wanted to clarify that. All right, number 5 here is Biden has proposed reestablishing the first-time homebuyers tax credit. So that would provide a one-time tax credit for first-time homebuyers, credit of up to $15,000 for their first home purchase. Now, this would be actually paid out upon the purchase of the property. It's been paid out at the settlement table, as opposed to being part of your tax return. So unlike most tax credits, most tax credits are part of your tax return. This would actually come to you at the settlement table to help you come up with the money to buy the house, to buy the property. Now, that is good news for people looking to house hack. And if you're not familiar with house hacking, just put a little link there to a little more information. But people who buy a property with the intent of renting out some of the units, for example, a duplex or a 3 or 4 unit property, move into one unit, rent out the other units. If this is their first home purchase, they would be able to use this first-time homebuyer tax credit toward that purchase, making it potentially more affordable for them. And I will also share a link to an example of someone, Becky Nova, who we just interviewed a couple weeks ago right here on this podcast. She and her husband reached financial independence in less than 3 years, which is pretty badass. That's pretty amazing. So I'll send a link to that case study as well for her. But they did this with house hacking. They bought a duplex, moved into one unit, rented out the other, lived for free, used all the savings from eliminating their housing payment to go out and buy more real estate, more rental properties. All right, so that's 5 tax changes or proposed tax changes that would impact real estate investors or your personal home ownership. All right, number 6 here is Biden has proposed raising the corporate income tax rate from 21%, where it is currently, to 28%. Now, it's worth just clarifying here that LLCs, so most real estate investors use LLCs for their real estate investing. LLCs are typically taxed as partnerships, or if you are a single owner LLC, taxed as sole proprietorships, not taxed as corporations. So that is something that's worth noting here. Whether the corporate income tax rate would affect you as a real estate investor depends on how you structure your legal entities, and it depends on the scale at which you're investing in real estate. So this may or may not affect you. But corporate income tax rate would be raised from 21%, where it is currently, to 28% under a Biden presidency. All right, so the 7th proposed tax change that would impact real estate investors is Biden has proposed boosting the low-income housing tax credit. So for investors who put money into low-income neighborhoods, many of them qualify for a tax credit, the low-income housing tax credit. The Biden campaign has been very stingy with details on how they would boost the low-income housing tax credit. So we don't know how much they would boost it, or really any of the details about how they would increase that. But they have talked about making that a little bit more accessible, making it a little more valuable to real estate investors who invest in low-income areas. So it's worth mentioning, but we don't have any real details on it to discuss. So just going to leave it hanging out there as a proposal that's scarce on details. All right, the 8th and final proposed tax change that would impact real estate investors is the change in the estate tax exemption. So we talked a little bit earlier about inherited properties and some of the proposed changes to how those would be taxed. On a broader level, the Biden campaign has talked about reducing the exemption on estate taxes. Right now, it's at $11.58 million. The first $11.58 million that you inherit from your parents, or from anyone for that matter, is exempt from estate taxes. If you inherit more than that, then those estate taxes kick in. So the Biden campaign has proposed reducing that exemption from $11.58 million down to, they say, around $5 million. So they have not given an exact dollar amount, but they're saying around $5 million would be the exempted amount from money that you inherit. So lower exemption for people who do inherit a more significant sum from their parents or from any other loved ones. Something to be aware of for real estate investors, and keep in mind that can add up quickly. We used that example earlier of someone who has a home that their parents bought for 50 grand, way back in the day. Now it's worth $1 million. If you get rid of the step up cost basis, and then suddenly it's not such a big leap to see how a middle class person could inherit more than $5 million if you're talking about real estate that does not have that step up cost basis. So that is a quick overview of some of the Biden proposed tax changes that would specifically affect real estate investors. I'll just summarize them real quick here for you before we wrap things up. So higher top tier income tax rate from 37% to 39.6%. Also, higher earners would start to pay 12.4% in Social Security taxes, again, above $400,000. Long-term capital gains taxes would increase for those earning over $1 million a year. They would be taxed at their regular income tax rate rather than the current long-term capital gains tax rate. Eliminate the step-up basis for inherited properties. Limiting itemized deductions for those earning more than $400,000 a year. You would reestablish the first-time homebuyer's tax credit, making it presumably a little more affordable to buy your first home. Raise the corporate income tax rate from 21% to 28%. Raise the low-income housing tax credit, but we don't know by how much or how that would work. And reduce the estate tax exemption from 11.58 million down to 5 million. So yes, we talked politics today. Hopefully, try to keep it as neutral as possible here, since people are very sensitive right now about politics. So, we're not trying to get political on you, just trying to talk about, what kind of tax changes we might be seeing come January if we do have a new president in the White House, which, according to current polls, is looking likely, but you never know. You never know what's going to happen come November 3rd. So on that note, we're going to wrap things up for today. Please rate and review the podcast on iTunes or Stitcher or wherever you listen. It helps us. And also, stay in touch with us. Let us know what you want us to talk about next week. We're on here every week talking about whatever it is that you want to hear. So shoot us a message over on our Facebook page, Spark Journal. Come to our website, message us through there. We're very easy to reach, and we look forward to seeing you next Tuesday, 2 o'clock Eastern, 11 Pacific. Bye now.